Have you ever wondered how to make a profit without any risk? Sounds impossible, right? But there's a strategy known as arbitrage that this very possibility. The term arbitrage is derived from an old French word arbitre, meaning to judge. Today, it refers to capitalizing on price differences in different markets. Imagine buying an apple for $1 in one market and selling it for $2 in another. That's arbitrage, buying low and selling high in varied markets. It's a clever loophole for risk-free profit. However, while simple in concept, arbitrage is complex in execution. It demands an understanding of market dynamics, quick decision-making, and occasionally advanced tech to detect and seize opportunities swiftly. Arbitrage, though mostly tied with finance, can be utilized in various sectors like commodities, retail, and online businesses. Spotting a price difference between two markets, that's arbitrage. It's an intriguing strategy, revealing human inventiveness and the relentless quest for profit. However, it also has its challenges and potential setbacks. Intrigued? Stay tuned as we delve deeper into the world of arbitrage. Now that we've piqued your interest, what exactly is arbitrage? Understand it as capitalizing on price discrepancies. Imagine finding a rare comic book at a flea market for $20. You know it's worth $100 online, so you buy it at the flea market and sell it online for a profit. That's arbitrage. In finance, it's a strategy used by investors and traders. It involves buying and selling securities, currencies, or commodities in different markets to profit from price differences. Picture yourself as an investor seeing a company's shares are cheaper on the London Stock Exchange than in New York. You buy in London, sell in New York, all within seconds, thanks to high-speed trading technology. This is financial arbitrage. Triangular arbitrage occurs with currencies when exchange rates don't align. But note, arbitrage requires quick decision-making, sophisticated technology, and an ability to spot price differences. It's not for everyone, but for masters, it can be profitable. As you can see, arbitrage is all about taking advantage of price discrepancies in different markets. So how does arbitrage play out in the financial world? Let's explore. In finance, arbitrage is a strategy exploiting price differences in various markets. Imagine a company's shares are priced differently in the US and Europe. You could purchase the shares in the US, sell them in Europe, and make a risk-free profit. This is arbitrage. Now picture larger-scale transactions. Institutions use computer algorithms to spot discrepancies, executing trades in split seconds. Tiny price differences generate significant profits. Arbitrage can also occur in currency exchange, where financial institutions can buy undervalued currency and sell it where it's overvalued. Merger arbitrage is another type. When a company announces a merger, traders can buy shares of the target company and sell them after the merger at a higher price. Arbitrage also exists in the futures market. In essence, arbitrage is a complex leading to significant profits. However, exploiting these opportunities requires resources and expertise. Arbitrage in finance is a complex game, but it can lead to significant profits. Stay tuned. Like any strategy, arbitrage has its pros and cons. Arbitrage's allure lies in its potential for risk-free profit. You buy a commodity cheaply in one market and sell it for more in another. The price difference is your profit, taken with no risk. It's like finding free money. However, arbitrage needs substantial capital. It's not for those with limited resources. The more you've to invest, the more you stand to gain or lose. And there's a risk of sudden price changes. In theory, arbitrage is risk-free, but prices can change fast. If the selling price drops too quickly, you could face a loss. And transaction costs are also a concern. Buying and selling involve fees, which can impact profits. In conclusion, arbitrage can be a lucrative strategy, but it requires meticulous planning and execution. It's a game where timing is crucial, and the music can stop any time. So tread cautiously, and as always, keep your wits about you. We've explored the world of arbitrage, but what are the key takeaways? This term, arbitrage, comes from the French word arbitre, which means to decide. It is a financial strategy involving the exploitation of differences in market prices. Traders buy cheaper and sell at a higher rate to profit from this discrepancy. This mechanism helps keep the market efficient and prevents prices from deviating significantly from their fair value over time. However, it is not without its challenges. Opportunities are fleeting and require substantial resources and expertise. Price discrepancies may vanish as quickly as they arise, and transaction costs can reduce potential profits. Successful arbitrage demands quick thinking, strategy, and attention to detail. The potential for risk-free profits makes it appealing despite the difficulties. And there you have it, arbitrage, a fascinating financial strategy with the potential for risk-free profits. Remember, with knowledge comes power, and with power comes the potential for success.